Our European equity dividend strategy has three main objectives. The first is to achieve income generation. The second is to participate in the upside of the equity market. The third is to offer a portfolio which is less volatile than the general market. And the main approach we do that is to combine both quality and yield. Quality means that we can generate good cash flow, and yield is exactly what we look for this strategy. Well, the European earnings so far have been very good, and the majority of the companies what we have seen so far have been beating market expectations, and hence what we see for Europe for 2025 based on the current consensus forecast is around a 3 to 4% earnings growth. In terms of the prospects, I think it depends very much on the outcome of the trade negotiations with the US. Having said that, I need to mention that the European corporates have sounded some caution for the next couple of months, which is understandable because the outcome of the trade negotiations with the US is very, very hard to predict. We do believe that European markets have a good chance to continue with the outperformance because the valuation of Europe is still very attractive and the earnings growth have been more or less resilient. That would provide a very good basis for further good performance going forward. Markets can go up, markets can go down, but the dividend stream is always the most stable source. And as the saying goes, a bird in the hand is better than two in the bush. I think during times of uncertainty, very stable income, very stable dividend stream is exactly what investors look for. I would like to mention two sectors in our portfolio. The first one is the financials. We think the financials still offer a lot of upside and very interesting opportunities. For example, the banks. The banks, with the normalization of interest rates in Europe, and their profitability has come to the normal level, and that is still very much underappreciated by the market. They have very, very attractive capital deployment policy as well, and with very good dividend and buyback strategies. The second is the insurance in the financial sector, and the insurance is always a very stable source of capital generation, which is in turn also returned to investors as dividends. The second sector I would like to emphasize is in the industrials. In Europe, we have a lot of industrials champions. These are the companies which benefit also from the infrastructure build out in Europe, and also they have very attractive dividend policies. The German fiscal stimulus is about military spend in the coming years and also the infrastructure spend. But I think the key thing to remember is for both spending the budgets in the coming years, they will benefit directly or indirectly a lot of other sectors. Let me start with the industrials. The industrials are a very important part of Europeans' effort to reindustrialize. And hence, we are going to see a lot of industrial companies benefiting from the increased spend over the coming years. The second part is about the construction, because the building out infrastructure will need a lot of construction measures, and the construction companies are the best way to play this theme. The third point I would like to mention is that with higher spend in infrastructure, in military, that would lead to more loan demand in Europe. Therefore, the banks in Europe will benefit also from this trend. Besides Germany, France has also launched France 2030 investment plan, which amounts to around 54 billion euros. And the focus is very much in renovation, in further developing Europeans' leadership in renewable energy. And another country I would like to mention is UK. Plan for Change, program by UK, will put a lot of focus in improving the efficiency of the economy and that will also lead to a lot of opportunities in the European space.